Welcome to the show. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We do this show every Monday through Thursday. Weekdays, we like to get started a little bit earlier, but it's one of those days when you have a big day like today. Big rebound. It does keep you kind of busy, and there's a lot to talk about. So let's just take into account the title of the show. Is this rebound real? Like, are we going up for a while, a sustained rally? Or is this just a dead cat bounce because things have been pretty negative? Did things suddenly change and all of a sudden they're good again? Oh, that's what we'll talk about. But if you ask me on a day to day basis, nothing's changed except that today is October 30th of 2023. And that's the only thing that's different than Friday when the markets were down. And this rebound, it's nice. It's a nice day, but certainly not enough to salvage the month. So July, August, September, and now October, you're starting to see statement after statement, monthly statements of down values. And it could start to wear on you, but I encourage you to stick to it. I'll tell you what I mean in a moment, how we do that. So let's roll a quick intro. If you have any questions, words of wisdom, words of encouragement during the live stream or in the repeat, because these stay on my timeline forever. So if you missed the show in the live, you can always come back to it in the repeat. And certainly while you're watching in the repeat, the replay, you can also ask your questions and your thoughts, whatever you want there as well. We already have Renee out there. Hey, Mitch, thanks for the fresh perspective and updates. Well, thank you, Renee. Thank you very much for that. You're very welcome. Let's roll the intro, and here we go. Boy, my tart. Hey, I want to show you something first. Check out this shirt. Can you see that? Hold on. Advice. Advice is good. That's from the creator of Life is Good. And the reason I bring him up is because I was in a conference in Grapevine, Texas at the Gaylord Texan Hotel and Resort just outside of Dallas. And it was an exceptional conference, and one of the two keynote speakers, he was the founder of the co-founder of Life is Good. It's two brothers that founded it. And, they had a very positive message, but it wasn't all positive. There was actually a part of the presentation where I just couldn't hold back and tears started coming out of my eyes. And the whole room of about 800 people, it was the same thing. But they had some really good points, and you have every day to look at. You could either see positives or negatives, and sometimes you could see negatives, which you're like, well, how could you not see them? But sometimes it's a way to change your thinking about something. So instead of saying, I have to do the laundry tonight because I traveled the last couple of days through Dallas and got to do that, you could also change it to say, I get to do the laundry because I can afford to travel to Dallas and have a good time and hobnob with my fellow financial advisors and do some real bonding with my fellow colleagues and my OSJ and the people that run HU Wealth Solutions, which owns the broker dealer that I use, Next Financial Group. And it was a really just a really cool trip. I happen to like traveling for work. To me, it's fun. I get to see different cities, different people. I always see friends I already know, and then I make new friends. And I saw one friend I've been friends with for like 20 years. He moved from Long Island to Dallas about 7 years ago, and this is only the second time I've seen him. So when we're there, of course, we had a chance to get together, and it was just a great time. So I learned a lot, good conference, but learned mostly that I really just have to keep doing the things that I'm doing and do more of it. Those things include, of course, continuously reaching out to clients, updating plans, investments, and it also includes making sure their documentation is up to date, but making sure that I am reaching out to their next generation, right? To the next kin. I kind of have like built-in prospects in a way, if you think about it, right? Not always, but in some cases, yeah. So just and just basically a lot to do for people, and it's very exciting, and it kind of reinvigorates you. But I am exhausted. I got home late last night, got up early this morning, and after being on the road for a couple of days and not sleeping in my own bed for a few days, it is a little, it's a little tired. It would have been better if I got home from the conference on a Saturday, but I got home late last night. Today's Monday. So anyway, we had a really big rebound in the market. The Dow is up a lot. We'll go over these numbers in a moment. But the question is this just a dead cat bounce? No offense to dead cats, but when the market has a big rally after a lot of a lot of downtime, we call it a dead cat bounce. Is it a dead cat bounce? Or is there something to this? Does it mean that we're out of the woods and all of a sudden we could start seeing things rosy again and valuations have gotten so cheap, so compelling that we should all be buying stocks again like crazy? All right, I have a few views on that. And to me, right now, with any rally, you are guilty until proven innocent. Okay, I'm not in a court of law. I don't have to say innocent until proven guilty. I'm talking about the rally. We had a bounce off of what apparently were extremely oversold valuations. Market's been going down a lot. Big tech stocks, the big tech related stocks, have been getting absolutely pounded. There are an awful lot of stocks that are down 20% or more this year, including some big names that you might not have thought of as being down so much. So buyers came in today, and what did they see that was so different? Well, for one thing, the price of oil has been down quite a bit. So that is a help. So maybe that starts to get a few people to stop selling. And then a few people start buying. Then other people who got out of the market, who were too lightly exposed to stocks, decide maybe I also got out too much. The market's rallying. I better get back in with some money. And it just feeds on itself. And that's what a lot of the buying and selling is. It's self-reinforcing, feeding frenzy type of trading, where once some people see the market going up, if other people don't want to miss it, they get FOMO, they want to buy. And same thing to the downside. It's going down. Maybe I better sell something too. Valuations became extreme. Investors were kept selling and selling and selling. And this is why we always preach here on Be the Boss of Your Money, to not overreact whatever the rest of the market is doing. The biggest detriment could be not you. It's your fellow shareholders who decide that they have to sell everything they can, and the market goes down. And then all of a sudden today, the market goes up. What was different? Nothing really. This is purely a change in sentiment. Psychology is a messy thing, and it's ephemeral. It's hard to really rely on it and judge it. So today we got this big bounce in the markets. Enjoy it. Maybe it'll make you feel better. It's not enough to salvage the month of October. You're getting down statement after down statement, month after month. It's probably wearing on a lot of people. And even though the market's been going down, it hasn't been awful. I mean, if let's just rephrase that. If you are someone who's in individual stocks, okay, if you're in individual stocks, it's a very different market than if you're someone who is in exchange traded mutual funds that are just following passive indexes, or if you're in some mutual funds, that sort of thing. All right. By the way, you can't invest directly into an index like the S&P 500 or the mid cap 400 or the small cap 600. There's a lot of different kinds of stock indexes. There's not just the S&P 500 index, but you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. I have to make that distinction in case somebody didn't realize that. You hear me say it every day. I know. I have to. It's the rule. I don't make the rules. I don't break the rules, and that's where we're going to go. See my number at the bottom of the screen scrolling by, 631-920-6624. Call that number if you want to speak with me. set up a one-on-one and see if we're a good fit to work together. It's probably worth your time. So we had a nice bounce. Let's take a look at how the action was today. All right. So the Dow up 511 points. Okay. Up 511 points. Look at that. Up 1.58%. NASDAQ had a nice up day, up 1.16%. S&P up 49 points. That's up about the same 1.2%. Gold, a little over $2,000 an ounce. But if gold is going up, first of all, gold has acted like crap for years and has never really reflected a gain or the view that there could be inflation. And now that inflation is down a lot from its peak, now gold is going up a little bit. I don't really look at gold as a hedge against inflation anymore. It's not something that's useful for that, in my opinion. It lost its usefulness a long time ago. Oil, though, I think is a better indicator, but down to the 82s. This is just 90. So down to the 82s, oil keeps going down. Wasn't oil supposed to go up to like 150 a barrel? We have this whole war going out between Israel and the Palestinians. There was some missiles fired, I think, today between Saudi Arabia and the Iranian-backed Houthis in Yemen. But that's been going on a long time. Somebody said, "Oh, that's a big deal." That look what's happening. But that's actually been going on for a couple of years now. The 10-year yield was up a little bit, 4.88%. The VIX was down to below 20, which I think is a pretty positive development. Let's take a look at the bond market. The bond market. Yeah, short-term yields still continue to be in the 5% range. They were up today mostly from the 3-month on, ever so slightly. The 2-year remains over 5%, and that's where pressure comes into the stock market. Because let me explain what people mean by stocks have a higher hurdle to climb. If interest rates are at zero, that means the risk rate of return is zero, the 90-day T-bill. That means anything that can do anything is worth something. So if anything that could possibly go up even a tiny, tiny little bit could be worth something. And things that are expected to be worth more in the future based on some kind of metric like earnings or cash flow are worth even more because interest rates are so low. But now that interest rates are much higher, over 5% for short-term yields, now any investment that you buy has to clear at least 5.5% just from a starting point to even be worth your while. And because interest rates are higher, that any money that a company makes in the future, that they're expected to make in the future, those earnings or cash flow is worth less today because interest rates today are higher. So it's wreaking havoc in valuations. However, today interest rates were up mostly across the board. The 10-year yield was up to 4.88%. It was a little over 4.9% earlier today. And yet stocks rebounded. Stocks could go up when interest rates rise, especially if they rise and then stay flat. But we've seen plenty of times in history when interest rates were this high and higher, and stocks have done okay. So today is just a day, though, that all of the usual excuses for the market to go down, high interest rates, geopolitical worries, those all went away. They're still there, but stocks still went up today. So maybe it's a day that investors just ignored the bad news and decided we've had enough. Stocks are oversold. And again, once one fund manager starts buying and stocks go up, the next guy has to buy, and the next guy, and the next guy. And before you know it, the chase is on, and now they're chasing performance. It's really tough to say what the market does next. And luckily, we're not really interested in talking about what the market does next. We're more thinking of, like, if you buy a stock now, what could it be worth? What if you buy stock now, what could it be worth in 10 years, maybe 20, maybe 15, maybe 5 years? I'll give you 5 years if you want. So that's what this whole ball of wax is all about. Let's take a look at a couple of individual stocks to make a point. Let's look at Tesla. Tesla was down another $10 today and another dollar in aftermarket trading. Its high was 299, down to a little under 199. So it's down $100, over $100. It's lost over a third of its value. And when was it at its peak at 299? Just this past July, July 19th. So July to August, so 3.5 months. Stock has lost a ton of its money. It was a $1 trillion market cap company. Now it's down to 624 billion. And you go back to the same argument. Maybe they're just selling something that's very expensive. The margins aren't as great. But didn't he just announce that other car companies are going to adopt the Tesla charging adapters? So now everybody will be using Tesla stations to recharge their cars. When a stock has very little earnings or has a high P ratio and trades on a lot of hype, it needs constant good news to keep the price of the stock going. But look at how much that stock is down from its peak. Is it still up for the year? Let's see. For the year, it's still up 60%, but it was up a lot more. And that makes sense if you look at NXP Semiconductor, which makes semiconductor chips for automobiles. That stock is down about $9 today, 225 down to 170. That's a pretty big hit. And then you take a look at ON Semiconductor, which had earnings before the market, was down almost 22% on the day. And it turns out the EV market is strong and it is growing. It's growing fast. But as much as it's growing, the hype was still ahead of the growth in the industry, meaning the stocks were still too high and you just couldn't justify it. That stock was at a high of 111 just recently, this past July, and today it's 65. It just goes to show you how dangerous individual stocks could be, and that's why they're not for everyone. So this is what we started the show with, and I'll end it like this. When you hear, don't worry, the market will come back, the market's not that much, things will turn around. It really depends what kind of investor you are, if that description even applies to you. If you're an individual stock investor and you're in a lot of large cap stocks, not just like large tech related or the Magnificent Seven stocks, there's a good chance you could be down 25% or more this year. There's a good chance you have stocks down a lot more than that. A good chance. I'm not saying it's a guarantee, but there's a pretty good chance. However, if you're in the index funds, you'd probably still be holding up a little bit better. You'd still be down for the year, especially because bonds are down. So bond funds are down. However, I've seen indexes recover pretty much every time, but I don't always see individual stocks recover. So some of you are sitting on stocks that are down so much, it's doubtful if they ever recover. And some of you are sitting in down stocks that you probably should hold on to for the ride. The trouble you get into is at what phase of your life is this happening? If this is happening, let's say 5 years before or 5 years after retirement, that's when it's a problem. And maybe we need to do something about that and take a look. Should you hold? Should you buy? What could you do? These are the things I do, by the way. But that's what's going on with the market. A really super strong bounce after it. I think was oversold conditions. And I'm not hanging my hat on this rally at all that it's going to last. I just think it's good that it went up and enjoy it. We'll see what November brings. At the end of this week, we have the non-farm payroll figures coming out on Friday. It's always a big number. It's the most important number that the Federal Reserve looks at when determining its interest rate policy. And speaking of interest rate policy, the Fed's next policy meeting is a 2-day meeting. It starts tomorrow. It ends Wednesday. And on Wednesday at around 2 o'clock is when the Fed will make its decision of whether if they're going to raise rates, lower rates, or keep them the same. The going is the Fed keeps them the same. That's the going bet. It's super consensus, I know, but that is the bet that I am taking as well. And then we'll see what they have to say for the next meeting, which is in December. And that's where we are. Thanks so much for watching. I'll be back tomorrow, and I hope you guys all had a great day and have a great night tonight. Thank you.